Stocks fell on Thursday as jobless claims came in at their lowest level in over a year, and that had some on Wall Street fearing a potential policy shift from the Federal Reserve. The NASDAQ really suffered the brunt of the selling today as it was down over 1%, whereas the other indices were down less than that. So we'll take a look at all that, see what it means for our posture. Then we'll get into a trade application example where I wanted to focus on a bearish short selling situation with a NASDAQ-oriented stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 3rd, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below to our description area and sign up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. I appreciate those of you that helped report my imposter yesterday as well as we had a second person trying to pretend they were me. So always be on the lookout there. I've got about 10,000 followers now, so if somebody else says that they're Brandon Van Zee and it looks like me, but it doesn't have the same follower count, then you'll know there's probably something amiss. So I appreciate the heads up from those of you that alerted me to that. And then last but not least, also have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the chart 4B pulled up here in front of us. And this will be our 4 grid to look at the 4 U.S. equity indices side by side. And we've kind of got a default view of the market forecast technical indicator guiding our discussion. And as you can see here, the S&P 500 did close lower today. It was down by 0.36%, which doesn't sound like a lot, but it was enough to actually have a posture change. So it gives us something to talk about here. As you can see, the posture on the chart has moved from bullish to bearish just barely. And let me qualify that by saying that this light pink color that we see here behind the S&P 500's candle here today signifies a weekly bearish posture. Remember, the weaker the bearish posture, the more easily it is for it to flip back to bullish quite quickly as well. Particularly in an instance like this, where the S&P 500 remains above a rising 30-day moving average, right? When the moving average is green, like it is here, it suggests prices above that rising moving average. So we have kind of a conflict of sorts between the market forecast, whose green line has fallen just ever so slightly. You can see it's at 79.89 and falling. And remember, anything above 80 would be considered bullish. So this is just barely in that bearish camp there. And so we don't want to make too much of this situation, as this could easily be a situation where as soon as tomorrow, it could be back to a bullish posture. The NASDAQ, on the other hand, has a little bit more of a bearish bent towards it, I would say. It's a little bit more concerning. You can see down below, like the S&P 500, the NASDAQ also had a posture shift from bullish to weekly bearish with today's pullback in prices. As I mentioned in the intro, the NASDAQ was the one that suffered the most today. It was down over 1%. It finished lower by 1.03%. Remember that a lot of growth-oriented companies make up the NASDAQ, and interest rates did rise today, and that has been a clue in the past as to whether growth stocks would either do well or not. If interest rates are rising, generally speaking, the cash flows that are discounted back to today are negatively impacted in such a way that growth stocks who don't expect to have cash flows for many, many years are suffering in the near term. And we've seen that story play out a bit so far in 2021. It seems to have some sort of an effect here today as well, with the NASDAQ clearly lagging the other indices with today's market activity. But the reason that I'm a little bit more concerned with the NASDAQ as opposed to the S&P 500 when it comes to the weekly bearish posture we now see is because of where it's placed in relationship to its 30-day moving average. With the S&P 500, I'm not nearly as concerned quite yet because Prices above a rising 30-day moving average, all else being equal, the path of least resistance continues to be to the upside, albeit somewhat more sideways these days than what we saw back here a couple of months ago. NASDAQ's a little bit more concerning because you can see that its price candle actually closed below a falling 30-day moving average today. So that's why the 30-day moving average is no longer yellow like it was yesterday when price closed above that falling moving average. Today, price closed below a falling moving average, and therefore the moving average changed to red. And the fear is that the moving average itself can start to act as resistance the more time a chart spends underneath of its 30-day moving average. And you can kind of see that playing out to a degree already with this chart over the last 3 months having spent a lot of time below the moving average. And in fact, this is one of the rare 3-month periods that we've had in recent years where the NASDAQ, you could get away with saying, has actually spent more time below the moving average than above it. Remember, the NASDAQ has been the leader of this market for many, many years. So this sputtering out that we're seeing here seems to be associated with rising interest rates that we've kind of been witnessing for the first time in quite some time in 2021. Remember, prior years we've mostly been seeing a declining interest rate environment. So you can look back over here on the NASDAQ and see that this moving average, after it was spending time below it, the moving average ended up acting as resistance right there. It did so again right there, and it did so for a day right there, but eventually got through it, came back down, started trading below the moving average again, used that moving average as resistance right there, pulled back further, came back on up to the moving average where we've been for the last, let's call it, week or so. And while it spent a little bit of time above the moving average, it never did so with a big push along the way. It always was kind of hovering right near the moving average. So it didn't give you that sense that it wanted to have some sort of a big breakout to the upside. And now today, a little bit more fear that the bears are kind of winning that tug of war that we're seeing there right now. So the NASDAQ, I think, is the one of these 4 charts right now that appears to be at the most slippery slope, the one where the bears have a chance to kind of take it and run with it a little bit more so than what we're seeing with the others. Let's talk about those other indices now. Dow Jones Industrial Average did close lower today, but let's call it flat. It was down 0.07%, so didn't lose much in terms of the mega cap blue chip types of companies that are out there. Like the S&P 500, it remains above a rising 30-day moving average, but unlike the S&P 500, it continues to have a strongly bullish posture according to the market forecast intermediate line. Notice the intermediate line here is at 63 and rising, so that's what makes it different than the S&P 500, whose intermediate line is actually placed higher at 79, but because it's now falling, it would be considered that weekly bearish tilt, whereas over here we've got kind of some more ambitious bullishness on the Dow Jones to allow it to continue rising with its green line in this particular case. We can see down below the Russell 2000 kind of remains in this holding pattern, probably with a slight bullish tilt right now, but we did have a bit of a give back here today. Russell 2000 was down 0.81% today, so it's a fairly decent sized give back, but I will say that it was a lot worse earlier in the session. You can see that it closed well off of the lows. However, this does set up the possibility here with this type of a candle where it could be a hanging man. And I know that's probably not the most politically correct thing to say these days, but I didn't name the price pattern, right? I think I've seen some technical analysis books kind of shift that theory from a hanging man to a hammer man instead. We've talked about that concept that the shape of the candle looks basically identical to a hammer. It's just a matter of where it's placed in the more intermediate pattern. If that candle is at a resistance area, it would be known as a hanging man, or if you want to change the vernacular, a hammer man. And if it's down at a support area, then it would be considered a hammer. And so if we evaluated this Russell 2000 chart down here, I do think that if I were forced to answer that question, I would say that we're at more of a resistance area than more of a support area. Then again, that's the beauty of technical analysis, right? The beauty is in the eye of the beholder. Some of you might look at this and say, well, we're sitting here right at support of this 30-day moving average, and that could very well be true as well. But what I would be looking at is the fact that the Russell 2000 seems to be struggling right at around the same level where it kind of topped out this last time around back here at the end of April. So be curious to see how that kind of resolves itself. We're getting a little bit of a rollover here. Does it come down to the rising 30-day moving average and then use that as support to bounce up and off of it to break out finally to the upside? Or is it going to kind of resolve itself the same way that it did last time, where it does not use that moving average as support, or at least not for many days, and eventually breaks through that? So at this point, remains to be seen. But if you're looking to add to your bearish trade, or perhaps lighten up your bullish trade, I think this style of a hammer might give you, or in this case, a hammer man, might give you that excuse to do so. Now keep in mind, most of these types of one-day candlestick formations need confirmation the next day. So if we do have a sell-off day tomorrow, we could then look back and say, yes, this was indeed a bearish candlestick here. But if it goes up tomorrow and it goes up above yesterday's high, then that kind of eliminates the possibility of that setting up as a bearish candle. So some of that won't be determined until tomorrow. We'll all have to find out together. And I think tomorrow is another big jobs number. Usually the first Friday of every month, we get those reports coming out as well. So it could cause a little bit of volatility as we move forward. All right, let's go ahead and take a look. And by the way, so just to clarify, I don't think I specifically said it, but the Russell 2000 does remain with a strongly bullish posture, even though it had a bit of a sell-off here today, as you can see from the background color of the chart. Let's go ahead and take a look at our 3 green arrows setup now. This will be chart 4D. And as this is getting pulled up here, you can see that we've got 3 of the charts on the board that continue to have a 3 green arrows signal. The only exception to that is the NASDAQ composite. You can see the NASDAQ composite now has a red arrow on the 30-day moving average, even though it retains its green arrows on the MACD histogram and the stochastics. So again, another sign that it appears that the NASDAQ of these 4 is the laggard in this current market that we find ourselves in. The other markets seem to be holding up a little bit better, perhaps a little bit more diversified, not always, but again, NASDAQ kind of concentrates itself with a lot of the growth-oriented stocks, whereas some of your old line companies like your materials companies and chemicals and insurance and all those old line types of companies tend to be more prevalent in the S&P 500 and Dow Jones and even the Russell 2000. So 3 green arrows on 3 out of the 4 charts, the only exception there being the NASDAQ composite. Let's take a look at our 1040 crossover method as well. Remember, the 1040 crossover method is going to be a longer term chart. Each one of these charts are 3 years in length, and each one of the candles is 1 week in length. And as you can see here, we continue to have bullish longer term postures. We can spot that easily by just looking at the background colors of our charts in the current formations, and they're all in that green color, telling us that the orange line has crossed up and over the blue line. The orange line is the 10-week moving average. It's going to be more sensitive than the blue line, which is the 40-week moving average. And so, we have reasonable bullishness out there from a longer term perspective. But again, I'll reiterate that it's not looking quite as strong as it was during large swaths of 2020, late 2020 in particular, and early 2021. You can see that we've had a bit more wear and tear using like the NASDAQ composite down here as an example. Notice that the PPO line, which is this green line down below, is pointing lower. And what that signifies is these lines up above, these moving averages, the orange line and the blue line, are pinching together right now. And what that kind of is describing is the fact that we've lost shorter term momentum. So as an example, back here, notice how the NASDAQ was just going up and up and up and up, almost in a straight line. And the same thing kind of happened here as well. Notice the orange line was separating itself up and away from the blue line in both of those instances. Now look at what's happened here in the last, call it 5-6 months or so. We've seen more sideways type of price behavior, and therefore the more sensitive 10-week moving average has not been able to kind of giddy up and go like it was able to a couple of times last year. So the blue line is still looking fairly steady, but it lags the orange line quite a bit, so it can kind of absorb a lot more up and down price volatility. So we'll see where that takes us and how it gets resolved, but that is one of the flies in the ointment here. In terms of the S&P 500 and the Dow Jones, you're actually still sitting pretty good there. We're actually at the 93rd percentile on the PPO for the S&P 500 and the 96th percentile for the Dow Jones. And so what that is saying is that on all of these instances on the chart, the separation between the blue and the orange lines here on the S&P 500 and the Dow are kind of at their highest points within kind of the top 10% of the times that you would have had any sort of readings over the last 3 years. So in other words, if you were to look at the separation of our current distance between the orange and the blue lines, these are among the highest on the board in the last 3 years in both the S&P 500 and the Dow Jones case. Now, neither one of them are at 100%. Remember, it can get there. So what that's telling us is that while we're still in the top 10 of all instances, we are not at the top of the instances. You can kind of see as an example right here on the S&P 500, it looks to my eye like the highest it ever got on that PPO probably would have been on the week of May 3rd, so about a month ago. It was a little bit stronger than where we're at right now. And again, that kind of makes sense as well as you see a couple of those red candles that have kind of found their way into the system here over the past month. So a couple of weeks where we had some more bearish trading activity there. All in all, I would say things are still holding up reasonably well from a longer term perspective in the U.S. stock market. Let's go ahead and pop on over here to the internet briefly. I always like to get an opportunity to say thank you to those of you that help support this free YouTube video. And the way that you let us know that you appreciate the videos and that you want us to continue to do them as often as possible. Remember, we do them on a voluntary basis, so the more of you that can encourage us to do the videos, the more we will feel inclined to do the videos. And so we would only know that by having you guys support us on social media, like on Twitter and so forth. So anyway, thank you to the 105 people that clicked like for us the last time around when I did the video last week. Remember, I was out of the office earlier this week. I had a nice weekend getaway, holiday weekend getaway up to Montana. So anyway, feeling relaxed and ready to go once again here. But so I didn't do the video earlier this week, but a week ago when I did the video, 105 of you did click like. So thank you to those 105 that help support this. I always say that seems like you guys get a pretty good shake in terms of our agreement there. You get 2 or 3 hours out of David and I's day, and all it has to take on your end is 5 seconds of your time to click like. And you can do it actually right here on our website in this little Twitter widget area, or you can go directly to Twitter where we typically have these pinned to the top of our timeline. We also include links to the tweet in the description area of the YouTube video for those of you that watch it there. And we also have a hyperlink within the email that we send out to you. So there's 4 different ways that you can easily get to the tweet if you are so inclined. And we do appreciate all of you that help us with that. Also, while we're over here, let's take a look at one of my classes that I taught here. This is our question and answer class that I taught earlier today. This is for premium students that want to pick the brain of David or myself during these particular sessions. So today we had some great questions, as we always do. I had a question about Old Republic Insurance. I had a question about Eli Lilly, kind of talking about its drug business and its potential impact with a big FDA decision coming up here on Monday in regards to one of their competitors, Biogen, and their Alzheimer's drug. We also had a question about how do I think about evaluating stocks with a discounted cash flow basis, return on equity, price to earnings multiples, etc. Had a question on Target versus Walmart and some of the history that we've had with both of those stocks in my dividend classes over the last 5 or 6 years and how to think about them here today. And then I also had a question about Sibanye-Stillwater, which is a lesser known platinum-based mining company over in South Africa. So if you're interested in those topics, that recording has now been posted to our calendar, and you're welcome to check that out if you are a premium member of Market Scholars. And then let's take a quick peek here as well at our factor selector. Remember, I put this graphic together on basically using Tuesday night's closing information, so it's a little bit stale at this point, nonetheless can still give us a good feel for anything that might be taking place from a factor perspective. And at this moment in time, there's not any sort of major shifts that have taken place. We continue to be in a market that is being led higher by value stocks. Think about your oil companies, think about your banks and other financial companies. Those are some of the areas that have done the best in 2021, and they continue to lead this market to the upside on a relative basis. Dividend yield is not too far behind. They're firmly there in second place. There's quite a bit of separation between number 2 and number 3 as an example. And so a lot of the dividend yielding stocks are doing quite well right now as well. We talked about Nucor Steel, a dividend aristocrat company in my class earlier today, one of the leaders in the entire S&P 500 this year. And so you do have kind of those two both in unison doing quite well on a relative basis. On the downside, unfortunately, are those momentum stocks, which, it's not the end of the world considering the performance momentum stocks put in last year. So it's a little bit disappointing perhaps in the short term, but considering the dramatic returns that they had in 2020 with a lot of the work from home types of stocks and e-commerce and other digital types of plays, they're sitting out part of this rally right here. This is not a rally that has been overly kind to disruptive stocks. This is a rally that has been a little bit odd at times, including with AMC and GameStop capturing the public's attention, but more to the point, more strong trends are holding within kind of the materials and energies and financials that I mentioned before. And typically you don't have those types of companies that are representing the momentum category. Right now, momentum still has a big chunk of technology within it. I just looked at some of the ETFs breakdowns on a sector perspective, and one of the momentum ETFs still had a 42% allocation towards technology here just as of earlier this week, because a lot of those factor-based ETFs kind of have a 1-year look-back period, so they're not necessarily looking specifically at what's happening in, let's say, the last 1 month or 3 months. They're looking at what are the returns over the 1 year time period that we've just had. And from that perspective, technology is still holding up reasonably well. It's really been in the near term where they've struggled, and I think that has limited the ability for momentum to do better than it would have otherwise. All right, let's go ahead and now pop back on over here to our Thinkorswim charts, and let's do some 12 grid analysis. Starting with chart 5A. Remember that the background colors of these 12 grids will be either pink or green, determining whether the posture is either bearish or bullish according to the intermediate line on the market forecast technical indicator. And as you can see, we've got 3 pink charts on the board, and they're all in that middle rung. Starting with the one on the left, we've got long-term U.S. Treasuries. Moving to the right, we've got foreign bonds, and then moving to the right still, we've got high-yield bonds. That one is a little bit surprising. Many of you know that for the past year or so, we've seen high-yield bonds and oil stocks moving in unison with one another. It seems like there has been a bit of a disconnect here in the last, let's call it week or two, where you've seen this nice burst higher out of oil itself and then also out of many oil companies. I was talking about Core Labs on Twitter as an example yesterday of a oil field services company that's breaking out to new yearly highs. But, Schlumberger was up a ton yesterday as well, and there's a number of them that were doing quite well. So I do know that a lot of those oil companies are doing better on a relative basis than other types of companies. And typically that had been the environment where that followed through and carried through with the high yield bonds as well. Remember, oil companies were on the brink of disaster just a couple of years ago. Many of them had to issue high yield debt, and many of them are representing the high yield bond space. So this was a little bit different to see those high yield bonds struggle on a relative basis versus oil and oil stocks themselves. There had been a pretty decent correlation between those two over the last year or so. So we'll keep our eye on that, but it's not a great sign to see all three of those bond charts trading underneath their 30-day moving averages. In the case of high yield bonds, the 30-day moving average is still rising, so that's why it's yellow there. In the case of foreign bonds and long-term U.S. Treasuries, we now have red moving averages telling us that not only do we have bearish market forecast postures, but we also have prices below falling 30-day moving averages. Now, many of you know we still have our bullish TLT trade on at this moment in time, and I'm not overly concerned about that because we've seen sideways behavior on TLT, and I'm pretty sure that that particular trade will expire here in a couple of weeks anyway in June. And with that bull put spread that we had sold, we just needed the chart to hold in there. We didn't need it to necessarily go up. That's the beauty of taking those credit spread trades is even sideways behavior will allow you to win the trade in most cases. So at this moment in time, I'm not sweating that trade, but we'll keep our eye on it. It kind of seems like it's using the 30-day moving average to me as more of a magnet at this moment in time, where it kind of comes below the moving average, goes back up to it. If it gets up above it too much, it goes back down below it, and it just kind of, you can see it just almost going sideways here more recently. In terms of the other charts, we have a lot of green on the board, but the charts do kind of differ in how they look. In terms of the better looking charts from a trending perspective, I would say that oil looks quite strong here. We were mostly flat today in oil, but we've had such a robust move in the last couple of weeks that just the fact that we're holding steady and holding firm at those higher levels is impressive because, remember, the stock market itself was down today. People were not in a risk-taking mood for the most part. This would have been a type of environment where oil could have sold off, and it chose not to. So I think that's a sign of strength right there. So I think that oil chart is looking rather impressive to me. I would also say that foreign developed stocks look rather attractive in terms of its trend. That's a nice steady uptrend that we're seeing there with EFA in particular. Gold was looking pretty good, but today kind of took it on the chin. Gave back a healthy chunk of that. I do know other mining types of companies were down today as well. We talked a bit about those miners in my question and answer session. But anyway, gold was down almost 2% today. You can see what that looks like on the chart. It's a pretty big give back that it had there, but because this thing was so far above its rising 30-day moving average, it can have a bigger than average sell-off day and still look reasonably strong. And that's kind of where I think we're at with gold. In fact, a lot of times you have this type of a gap that we see here with a 2% down day, you should assume that the background color would not remain dark green. You would assume that it could perhaps shift to a light green, in other words, weakly bullish, or even possibly shifting to one of the pink colors, showing us bearishness. So that just goes to show you how strong gold has been, that it can give back a really large chunk of its recent gains and still be considered strongly bullish at this moment in time. So we'll keep our eye on that, but for those of you that kind of felt like you missed the move up in gold in the last couple of weeks, perhaps this is kind of resetting the deck for you and you can now try to grab those at a better price. In fact, I'd be curious if gold ends up having a bullish intermediate confirmation signal. Remember, we can check that by right-clicking on the chart and then going to maximize sell. And indeed, my gut was leading me in the right direction. That's exactly what we have here. We've got a red line in the lower reversal zone. We've got the green line falling but remaining in the upper reversal zone, and that constitutes a bullish intermediate confirmation signal. Now, ideally, we want the blue line to be between 50 and 20, and that we are not quite getting. You can see the blue line is at 54 and falling. So wish that was a little bit lower, and that does set up the possibility that maybe gold has another day of a give back tomorrow. And then, at that point, maybe there's enough of an exhale where the bulls will step in and start to support that price action once again. So keep your eye on that possibility. I'm not giving up on gold quite yet. I think it's established itself in a pretty nice upward trend, and I think that commodities seem to be in favor in this market where everybody seems to be concerned about inflation all of a sudden. By the way, US dollar was up today. It has a weekly bullish posture. However, it landed right on the underside of the falling 30-day moving average. So this will be a very interesting test for the US dollar. And that perhaps is why gold fell so much today. That's a pretty aggressive up move for the US dollar, a 0.62% move there. And so if the US dollar is up, all else being equal, gold, like a lot of commodities, struggles, and that is what happened today. So if the US dollar ends up using that falling 30-day moving average as resistance and bounces down and away from it, that would set up a strong possibility that gold will now start bouncing back higher. So be on the lookout for that possibility there as well. Let's take a brief look here now at the sectors 12 grid. Just wanted to point out that we had about a split decision today as to whether we had bullishness or bearishness, and the larger sectors were the ones that had the struggles, and that's why the overall indices were red today. Remember, all four of our major market indices were red today, so it might be a little bit surprising to learn that on an individual sector basis, we basically had just as many up sectors as down sectors. It's just that the sectors that happen to be up today are some of the smaller sectors within the market, and they didn't have enough oomph to actually turn it for, let's say, the S&P 500. But the biggest winner here today was utilities. They were up 0.6%. Actually, I take that back. At the end of the day, it looks like staples came in and dethroned them. I know earlier in the day utilities were leading, but right at the end it looks like staples were up 0.62%, utilities were up 0.6%. We also saw healthcare up 0.3%, we saw energy up 0.27%, and we saw financials up 0.24%. Of those charts, I like what I see out of energy, which is basically trading at 3-month highs right now. And I also kind of like what I see there out of staples. Haven't been talking a lot about them, but they've been nice and consistent to the upside. I noticed yesterday Clorox came out with a dividend increase as one example there. But don't fall asleep on those staples. They're not the most exciting stocks on the planet, but they can offer fairly decent trends on occasion. And while I didn't mention real estate as being up today, they were actually down 0.20%. I will reiterate what I mentioned a week ago, which is the real estate chart looks really quite interesting and quite promising, and I was impressed with the fact that they were able to basically recover all of their losses from the coronavirus fallout because real estate was so directly involved in many of those government shutdown decisions that happened to malls and apartments, and not necessarily apartments, but how about office buildings and other things like that, where a lot of those buildings just were not getting used the way that they would prior to the pandemic. So the fact that real estate as a whole is now back up here to all-time highs is quite the feat that they've been able to pull off there. In terms of the charts that are looking a little bit more worrisome, I'm going to keep my eyes on technology and discretionary. Those two are becoming more concerning. I mentioned before that technology was kind of struggling here, and that kind of added to the fact that the NASDAQ composite was down so much today, and perhaps it was the rising interest rates that was causing a little bit of selling there in the tech stocks. When it comes to discretionary, I think a big chunk of that was Tesla. Remember, these are the market cap weighted versions of these sectors, and so XLY does have an unusually large component of Tesla in it, along with Amazon and Home Depot. But Tesla in particular struggled today. If you want to look at the chart here, you can see it was down 5% today as they had some recall news that hit their shares negatively. And you can see Tesla has been kind of struggling here for the last 3 months or so. So that does have a bigger impact on XLY because XLY is market cap weighted, not equal weighted. So as you look at this chart on XLY, it's not looking so hot. I think you guys can all see that dark pink background color. We've got a red 30-day moving average, prices below a falling moving average, and it looked like it used that moving average as a resistance area where it's bouncing down and away from it. So not a great look there out of discretionary. All right, let's go ahead and get into our trade application example now. And knowing that technology stocks were struggling today, I wanted to look at a very well-known company by the name of Intel. Of course, one of the legendary Silicon Valley companies out in California, and has been for many decades at this point. But many of you know that the semiconductors are having a little bit of a struggling moment right now as they're having a hard time with their supply chain. And it has me wondering if Intel is starting to roll over once again here. And so what I opted to do in today's trade application example is a simple short sell, and a reminder that those of you that are premium members have access to our Telegram app. And so you would have known that I did this trade already earlier in today's session. And so this is the chart that I use in my swing trading class. And what it's showing us here in terms of the background color is that the blue line is now considered to be bearish or negative. So when this blue line rolls over like it has here, it changes the chart's background color from blue, where it was positive when it was rising the day before. Now with today's 2% sell-off, it now has changed that posture back to bearish. Now remember, the blue near-term line is going to move around a lot more than the green line that we normally look at on the market forecast. Remember, the green line we look at for trend trading purposes, where we want to be intermediate term trend traders. Swing traders tend to look at the blue line, where you do have more sensitivity in the movements both up and down. And so with today's pullback, we now have reverted back to a bearish near-term posture, and you can see that it is now also below a falling moving average again here today after having a brief reprieve from that yesterday. And it does give you the impression that it's kind of stalled out here in the last week or so, and it's kind of using that falling moving average as a resistance bounce down area. And this is actually the lowest that Intel has traded since going back to this candle on May 21st. So not the healthiest of looks right there. You can see it's woefully underperformed the S&P 500 over the last 3 months of this chart. It's down about 6%, not including the dividend, and the S&P 500 actually has a slightly positive performance over that time period. So, it's kind of playing into that theme where technology has fallen out of favor, and we're going to see if we can press our bets to the downside with this swing trade. You can see these levels that I have on the chart here representing my stop loss up above and my price target down below. And if you need the specific levels to the penny, again, check your Telegram app if you're a premium member. I've got all the screenshots and everything in there. So that's what I had for you here today. Also note that the intermediate line is falling at this moment in time as well. So not only are the swing traders somewhat interested in a bearish trade, but we also have the trend traders that might also be looking at Intel as a bearish trend trading example in this case. Okay, so appreciate you checking out the video as always. Now remember, David's on vacation this week as far as I know. I think he's actually teaching a basketball camp. Many of you know that he's a high school basketball coach as well. So kind of playing a couple of different coaching roles, a financial coach and a basketball coach. So he's off doing some team basketball camps this week. So I don't think he'll be doing his normal class or presentations tomorrow, but I'm sure he'll be back with us here next week. So if you appreciated the analysis I gave you here tonight, I ask one and only one thing out of you. Just simply click like for me there on Twitter, and I'll look forward to working with y'all next week. So with that, I wish you all the best of success with your trades and your investments. Goodbye for now.